I'm Alan Kinney, Editorial Director with REIT.com, and we're at the Wynn Las Vegas for REITWorld 2015, NAREIT's annual convention for All Things REIT. I'm joined by Jim Heistand, President and CEO of Parkway Properties. Jim, can you tell us a little bit about how your company's capital recycling strategy has impacted asset sales and the portfolio overall?
Well, it's been a couple of parts. When we took over, there was a lot of legacy Parkway assets that didn't have the quality or the location that we wanted to, as core investments long term. So we've mostly recycled out of that capital. We've only have probably 3 or 4 buildings that remain in the original portfolio. So going forward, any of the things that we might recycle would be stuff that we purchased where we think there's outsized returns in a very short period of time that we would monetize that might not be kind of long-term core holdings going into 16.
So in 16, can we expect that same level of activity?
I don't know that it'll be the same level. We're largely through it. So I still think we will be a net seller of assets in 16. More difficult to find opportunities that have the kind of right return profiles for us. But so I would say through 16 wouldn't be the same volume, but we'd still be a net seller.
And looking at your kind of core portfolio, are there any areas that you expect to outperform next year?
Yep. We've really been focused on submarkets within cities, so I'll speak to kind of the submarket of the cities that we think are currently outperforming and we expect to next year. Tempe, we have a very large presence in Tempe and Phoenix. We expect that to continue to outperform, and we just built a new asset that came online full, so we'll look to maybe do more of that in Tempe. Austin, the CBD in Austin, we have 1 million square feet there. The rents have risen tremendously, and we're looking for more opportunities in that market. Buckhead market of Atlanta, rents have moved from high 20s to $40 in a pretty short period of time, as well as the CBD in Charlotte. So if I were to say 4 markets within our portfolio that we expect to continue to outperform, would be those.
And so what kind of impact do you think that mobile technology is having on demand for office space?
Well, let me just clarify, let me just caveat, I'm not a technology guy, all right? I got guys who know a lot more about that than me, but it's not just mobile technology. Technology is affected in 2 different ways. Just generally, people need less office space. Law firms don't need law libraries. They don't need as many assistants per person just because of technology, right? People can do more themselves. So people need less assistants and they need a storage space. So that's generally just a kind of a reduced need for office. In terms of the mobile technology, people always work from home, they work from the office, but people work in cafes now, they work at Starbucks. So what we try to do is a couple things. Number one, we've partnered with Google Fiber to put very high-speed internet in our buildings so that we're 100 times faster than on average, which helps the people who are sitting in the lobbies and the conference rooms to interface and obviously have higher productivity. And we've tried to create kind of common workspaces in our properties that have amenities where people can actually work when they're not in their office, even though they're at the office, right? So it's changed considerably for those 2 parts, but you really need to have the right asset locationally to be relevant. I mean, people really want to be in an amenity-rich, and that's not just technology, but it's the younger workforce that are really technology-driven.
Well, thank you so much for your time, Jim.
All right. Hopefully that's helpful. Thanks.
Be sure to visit REIT.com for more from REITWorld 2015.